It is now time that we look at your money management. Now remember, without any good money management system, your method will fail. I can give you the best method in the world. I can promise you, if you don't manage your money and your risk correctly, that method will ultimately fail. Now the first decision you will have to make is you will sit down with your spouse if you're married and make a decision of how much money are we going to put aside for speculative trading, for risk trading. No, it's not your money that you have to pay for taxes in 4 months' time. No, it's not money that you have to pay your kids' school fees from or money for your old age. No, it's risk money. It is money that if you lose it, it will not change your lifestyle at all. Yes, it will not be nice. It will be painful if you lose it, but it won't change your lifestyle. So once you've made that decision on how much money to put aside in that account, then you know that all the funds in that account is risk money and you don't move beyond that amount. This is the most important thing for any method, is to determine how much money you're going to trade with and what is going to be your risk profile. I think the number one rule for any good method is a very, very good money management system. The second question is then, how much of that money will you be risking on every single trade? It is very important to decide how much you can handle emotionally based on your financial position. So this is one of the most important decisions you will make, is how much money you're going to put in that trading account. Because your financial situation, your emotional ability will be influenced by that decision. So the next question is, how much money will you risk on every single trade you're going to take? Now, my aim is usually 1 to 2% of your portfolio. So if you're trading with $1,000 portfolio, you will look at $10 for 1% up to $20 for 2%. Some of the times you will just risk 0.5%. Some of the times you will risk 1.5%. But the golden ratio is between 1 and 2% of your portfolio. That's not exposure, that is risk that you can take, money that you can lose. It's that amount that you put into the slot machine. Now, what is this risk I'm talking about? It's the distance from entry, that entry point, to your stop loss level. Now let's take an example, because stop losses will differ on every single trade that you take, on every single strategy. So it's not just this 10 pips or 50 pips or 100 pips. No. Every strategy, every trade will have a different level of stop losses. We're going to allow the market to tell us where to put our stop losses. We're not going to thumb suck those stop losses. We're going to allow the market to tell us where to place that stop losses. Now, as I've said, the stop loss is it's the difference between the entry point and the stop loss level. Now, let's just take an example. Let's say we're lucky enough and we buy Google at $100. Now, we're not talking shares here. I'm talking Forex here, or indices here, or cryptocurrencies here. But I'm just using shares because that is much more known by most people. So let's say we're lucky enough buying Google at $100. And we decide to say, all right, when Google falls to $90, that will show me that I'm wrong. So if I buy one Google share and it moves from $100 to $90, I've lost $10. That is your risk. That's what you can risk. So let's say you decide to buy 10 Google shares and it moves from $100 to $90. It means you have lost 10 times, that's the amount of shares, 10 times $10 risk per share. It means you've lost $100. So if the price moves from $100 to $90 and you have bought 10 Google shares at $100, and by the time it reaches $90, you have lost $100. So that is, when I talk about risk, is the distance between your entry point and the place where you will stop, where you will take away the trade, where you will close the trade. What does stop loss mean? It means stopping the pain. Stop loss is a point on the chart where you are wrong. Now I'm saying wrong, but it means that your strategy tells you that this time around your trade might not work, so rather get out of the trade. That's the amount you've put in the slot machine. Remember always, it's important to hit that stop loss because a cluster of bad trades will come. It will come. It's not something that if it comes, it will come. It comes in every trader's journey. So a cluster of bad trades will come. It is not something that just happened to other people. It happens to everyone. It's guaranteed. You will have a cluster of bad trades. How big will that cluster be? I don't know. 5 trades, 10 trades, 20 trades. It's impossible to say. But you will go through those periods where just everything you do just goes wrong and the trades fail. So that's why a stop loss is so important. Remember that a cluster of bad trades that can destroy your account and your emotions completely. You know, after having 10 or 20 bad trades, it's tough enough sitting through a half or a 1% loss on all of them. Sometimes it's just smaller losses due to trailing stop losses. But just think, if you haven't adhered to your risk management, to your money management, how much will you lose if you get 10 or 15 bad trades in a row? And again, it will come. It's not something that might happen to you. It will happen to you. So remember that the stop loss is a place on the chart, which I will show you on every strategy, where the probability of this trade being a success has really diminished into almost nothing. Your whole trade is compromised. And that's when you have to get out of this trade. When placing stop losses, remember that a stop loss is there to get you out when you are wrong, not when you're right. A stop loss is a well-calculated place. We're going to allow the market to show us where to put it. But you must understand, putting a stop loss at a stupid place doesn't help. You can just as well exit the trade. Or trailing your stop loss to a stupid place or place that doesn't make sense. That's why it's so important to analyze the market correctly, that you know where to put your stop losses, because you only want to get stopped out when your trade idea is wrong. You don't want to get stopped out most of the time and then the market turns around and goes to your target. Yes, that will happen every now and then, where the market comes and ticks your stop loss and then it goes up. That doesn't mean your stop loss were at the wrong place. That's just running the stops. But if that happens a lot to you on a consistent basis, it is time to revise the place where you place or you put your stop loss. Remember the saying, the stop loss is there to get you out when you are wrong, not when you are right. So if the stop loss at the correct place is a little bit wide, it's still fine. Just trade slightly smaller. That's all. Don't go and say, I want to trade a specific size, so I'm going to bring my stop loss closer to bring it within what I want to do. No, put your stop loss well out of the way at the correct spot. Just place a smaller position. That's all you need to do. Never bring your stop loss closer so that you can trade the size you want to trade. It's never this fixed amount. It's never this 10 pips or 50 pips or 100 pips. I only trade. Scalpers, they've got that type of attitude. In my humble opinion, that is not a good way of trading. So it's gonna be a place on the chart. It's not a fixed amount. It's never a fixed amount. It's never a fixed amount of pips or points or dollars. Never do that. It's a place on the chart, and it will vary every time. Sometimes your stop will be 50 pips, sometimes it will be 20 pips, sometimes it will be 200 pips. Depends on the strategy, the time frame, and where to put that stop loss. Just remember always, a trader always manages risk with a stop loss.